Lewis, how do you think financial statements alone are in predicting corporate failure?
Yeah, look, financial statements and ratios, they're an important aspect of, credit scores, how we rate businesses, but they're definitely not the only thing. I don't think you can use them in isolation. So financials is one part of the story. You got other public information like defaults and adverse data, which tells a lot as well about a particular firm. At Experian, we also track, trade data. So trade activity, payments between businesses are very vital. So, not only the raw financials, but, actual transaction between businesses, those cash flows are really important to suppliers and whatnot. So that's also a big element of our risk scores. And then finally, recently we've started to look at more, director information. So especially for small businesses and in businesses where, we can get consent to look at an individual's credit scores or personal credit scores, that we've found that to be actually very powerful in assessing a business's financial health. So, if you think about a small business, there might be only a handful of employees, one or two directors. How they manage their credit or personal credit situation is very correlated with financial health. So I think, that's going to be a big focus, especially for, small businesses.
Well, I think with small family businesses, it makes sense to me what you just said. Because I think with small family businesses, they will tend to use the family business as an extension of their own personal finances. They'll take money out of the company, they'll set up a loan, they'll take the car, whatever, they'll treat it as their own personal assets, even though it's a company in itself. So I can see where they would get drawn into that by using the company assets to support their own. Let's just say they'd made an investment in a property somewhere or a project or a business and it was going wrong, then they're more likely to dip into the assets of the company.
Yeah,
I think so. That's a good observation, I think.
Yeah, and that's probably more relevant or more, it's more powerful on the smaller business end, how directors manage their own finances. Actually, some of our newer credit scores were also focusing more on the hierarchy, so the parent company's risk. So in slightly bigger companies, there might be a parent company behind it, looking at the risk of those parent companies is also very vital, just because there's definitely a flow-on risk with that.
I mean, from our side, Atradius' side, we always look at the group. I mean, if you've got a subsidiary, we never look at the subsidiary in isolation. We always look at the strength of the overall group. We look to see if the financials, if there's consolidated financials, we look to see the position of that group. We'll definitely take into account a group position. We tend not to look at a company in isolation because they could be upstreaming of dividends.
Absolutely. Yeah.
There could be, the particular subsidiary could be strategically loss-making for whatever. It could be using it for tax reasons. It could be any number of reasons. You've got to look at that consolidated group position if you're really going to assess the company properly. So, we do that too.